receivables. So this section is just talking about how the receivables show on your financial statements, how you go about managing the receivables. So if we look at the statement here, it's showing a pretty detailed breakdown of the receivables. You're not going to see this on the financial statements in this class. You're just dealing with accounts receivable and notes receivable. But this is just giving you an example of how it might look for an organization, breaking down to the different types of receivables. So you won't be doing anything with that, anything like that. So managing receivables, you will not have this on your exam or your homework. This is more just information for you to know. When we talked about the merchandising company, one of the biggest pieces that keeps a company successful is the idea that they're able to collect their money so that they can buy more merchandise or buy more raw materials to make more merchandise. So then they have something to sell. If collections are not well done, if the receivables are not well managed, it can actually put a company out of business. So when you have somebody that works in receivables, they may or may not be the person that decides how credit is extended. You may have an actual credit manager that does that. But when you're managing the accounts receivable, the things that have to be considered are you have to determine who you're going to give credit to. You have to determine what the parameters are. Like, is there a certain income level? Do they have to have a certain credit score? What are the different parameters that you have to take into account? You have to establish a payment period. Is it going to be 2% 10 net 30? What is it going to be for accounts receivable? If it's notes, what are your notes going to be? Generally, companies don't go all over the board. Like, they have a 190-day note, they have a 500-day note, they have a 60-month note. It's more that they may have like a couple different, like maybe they have for car loans, they might have a 3-year loan, a 5-year loan. They're going to be pretty limited in the different types of loans they have. Not that they always are like that, but most companies are like that. Some may be different though, and have many different types that they offer. You have to monitor the collections, and we talked a little bit about that when we were looking at the merchandising and the aging of receivables, figuring out who owes you what and when. And then there's evaluating the liquidity of the receivables. How much cash do you really think you're going to gain from that? And then accelerating cash receipts from receivables when necessary. So that's where you might want to do the factoring, like we looked at in, I think it was the last chapter or the chapter before, where you sell your receivables for a percentage fee, but you get your cash early. So with extending credit, you need to just think about having a credit policy that's not too tight, but not too loose. You need to get your money, but you need to give your customers some time to pay as well. And you want to ensure goodwill so that your customers continue to use your company as a supplier. This just kind of talks a little about the payment period. We don't need to talk about that. We've already talked about the monitoring of collections. We've already talked about the factoring. And then this is two ratios that companies do. You won't be doing these, but one of them is called accounts receivable turnover, where it looks at the how often the accounts receivable turns over in a year. And the other one looks at the average day to collect payment on your accounts receivable. So those are important numbers that are watched within accounting in order to monitor the health of the receivables within the organization. And we're not actually going to do any of those in the homework or on the exam. So we're not going to be doing this problem here, but that's just more information for you. And that's the end of the slides for this chapter.